For most people, a currency only feels like it is dying when something dramatic happens. Hyperinflation, a redenomination, banks closing their doors, long lines at exchange counters, news headlines screaming collapse. But the most destructive monetary failures rarely look like that. They look boring, quiet, manageable. The currency still circulates. Salaries are paid on time. Prices rise, but not explosively. Governments insist everything is under control. And because nothing breaks in a single moment, people assume nothing fundamental is wrong. This is how currencies that never recover begin their decline. At the start, everything appears stable. Inflation exists, but it is explained away as temporary. 5% becomes 7. 7 becomes 10. Each year, it feels tolerable because last year was not that different. Wages rise nominally. GDP grows in local currency terms. On paper, the economy is expanding. Politicians point to charts that move upward and claim success. Central banks speak in calm, technical language about anchoring expectations and maintaining stability. There is no obvious reason for panic. This is the illusion. People judge a currency by whether it still works day to day, not by whether it is silently losing its core function. Money has 3 roles: medium of exchange, unit of account, and store of value. The first 2 can survive for a very long time, even as a third one dies. A currency can keep functioning in transactions while steadily failing as a way to preserve purchasing power. When that happens slowly enough, most people never consciously notice it. Japan after 1990 is a clean example of how this illusion forms, even without visible inflation. After the asset bubble burst, the yen did not collapse overnight. There was no mass rejection of the currency. Instead, Japan entered decades of near-zero growth and persistent monetary intervention. Nominal prices were stable, sometimes even falling, but asset prices never returned to their peak in real terms. Someone who earned yen, saved yen, and trusted that time alone would heal the economy discovered something unsettling. The recovery never came. The currency survived. The system survived. But the promise that money saved today would meaningfully translate into future purchasing power quietly eroded. Italy offers another form of the same illusion. From the 1970s onward, the lira experienced chronic inflation, often in the high single digits or low double digits. There was no single year where the currency died. Instead, inflation compounded. According to historical data, between the mid-1970s and the late 1990s, the lira lost more than 80% of its purchasing power. Yet for most of that period, Italy remained a developed economy. People worked. Businesses operated. The currency circulated normally. The damage was not visible in daily life, but it was devastating over time, especially for households who held savings in cash or fixed income instruments. Argentina shows the illusion even more clearly, because it has repeated the process multiple times. Before every major reset or redenomination, there was a long stretch where inflation was elevated but not yet catastrophic. In the late 1990s, the peso appeared stable under the currency peg. In the 2010s, inflation ran persistently above 20 to 30%, yet daily life continued. People adapted, contract adjusted, salaries rose nominally. Only in hindsight does it become obvious that the peso had already failed long before the crisis moments. People remember. What ties these cases together is not collapse, but normalization. Inflation becomes background noise. Purchasing power loss becomes something people adapt to rather than resist. When a government can borrow its own currency and roll the debt forward, there is no immediate forcing function that demands reform. Pain is spread across time instead of concentrated in a crisis. This makes the system politically survivable, but economically corrosive. Data reinforces this pattern. Looking at long-term inflation figures, a currency losing only 5% of purchasing power per year will lose roughly 40% over 10 years and nearly 65% over 20 years. At 8% inflation, the loss over 20 years exceeds 80%. These are not extreme numbers by historical standards. Many developed and emerging economies have experienced similar inflation for decades without triggering collapse. Yet the outcome is the same. The currency that exists at the end is not the same currency in terms of what it can buy. Crucially, people do not experience this loss as a single event. They experience it as a series of adjustments. Smaller apartments, later retirement, more household members working, greater reliance on credit. Each change feels like a personal or social issue rather than a monetary one, because everyone around you is adapting at the same pace. The decline feels normal. Governments and central banks reinforce the illusion by framing success in nominal terms. GDP growth is reported without adjusting for purchasing power. Asset prices rising are treated as signs of prosperity, even when wages lag behind. When inflation outpaces income growth, the official response is often that real wages are temporarily under pressure. Temporary can mean years, eventually decades. Another reason the illusion holds is that currencies rarely fail symmetrically across society. Those with access to assets that reprice with inflation, real estate, equities, commodities, foreign currencies feel protected. Those dependent on wages and cash savings absorb the loss. Because the most vocal and influential segments of society are often insulated, the system appears healthier than it is. The currency continues to function for transactions, while its role as a neutral store of value quietly disappears. Importantly, none of this requires bad intentions or incompetence in the short term. Once a country accumulates large debts denominated in its own currency, inflation becomes the least politically painful way to manage them. Explicit defaults are traumatic and immediate. Inflation spreads the cost invisibly over time. No single law announces it. No single official signs responsibility for it. The erosion happens through thousands of routine decisions. This is why the early stage of currency that never recovers looks indistinguishable from normal economic life. There is no drama, no cliff, only time. People keep using the currency because there is no obvious alternative. They keep trusting that stability will return because it always has in living memory. And by the time it becomes clear that the recovery is not coming, the loss is already compounded beyond repair. A currency does not need to die to fail. It only needs to stop delivering what people assume money is supposed to do. The tragedy is that this realization almost always comes too late, after decades of quiet decay have already done their work. The real damage begins after the illusion has settled in. Once a currency has proven that it can lose purchasing power without provoking revolt or collapse, the system quietly adapts around that reality. This is where erosion replaces crisis. Nothing dramatic happens in any single year, but the mathematics of time take over. The currency keeps circulating, yet each unit buys a little less than it used to. Over long stretches, that little less becomes everything. Inflation is usually blamed, but inflation alone is not the full mechanism. What matters is cumulative inflation, combined with policy responses that prevent losses from ever being fully corrected. If prices rise 6 or 7% one year, and then another 5% the next, the base has permanently shifted upward. Even if inflation later slows, the lost purchasing power does not return. Prices rarely fall back to previous levels, and wages almost never catch up fully. This ratchet effect is subtle but relentless. Historical wage data makes this clear. In Italy, for example, nominal wages rose consistently from the 1970s through the 1990s. On paper, workers were earning more every year. In real terms, however, wage growth frequently lagged inflation. Studies from the OECD show that Italian real wages stagnated or declined across long stretches of this period, even as the economy remained functional. People did not feel poorer overnight. They felt squeezed year after year, adjusting expectations downward without ever labeling the currency as the culprit. Negative real interest rates accelerate this process. When interest paid on savings is lower than inflation, holding money becomes a guaranteed loss. Yet this condition can persist for years without triggering alarm because the losses are not visible. A savings account does not show a negative number. The balance grows. Only purchasing power shrinks. In Japan, from the late 1990s onward, interest rates hovered near zero while the central bank aggressively expanded its balance sheet. Savers were not punished loudly, but they were punished continuously. Cash stopped being a vehicle for future security and became a parking place that slowly leaked value. Debt dynamics play a central role here. Governments that carry large debt loads benefit directly from inflation that exceeds interest costs. Every year of moderate inflation reduces the real value of outstanding debt. This creates a structural incentive to tolerate, or even quietly prefer, persistent inflation. There is no conspiracy required. The incentives align naturally. Fiscal pressure makes price stability less attractive than it appears in textbooks. Argentina illustrates how these incentives translate into lived experience. Throughout the 2000s and 2010s, inflation consistently exceeded official targets. Even during years without acute crisis, annual inflation often ran above 20%. Households adapted by spending quickly, holding foreign currency informally, or buying durable goods as a hedge. The peso still functioned. People were paid in pesos, taxes were collected in pesos, and shops accepted pesos. But saving in pesos became irrational. The currency store of value function had effectively failed long before the more visible collapses arrived. Asset prices provide another lens on erosion. When inflation and monetary expansion are persistent, assets that reprice with monetary conditions tend to pull away from wages and cash. Housing equities and commodities absorb excess liquidity. This creates the impression of wealth creation, but it is largely a reallocation. Those who already own assets see their net worth rise. Those who rely on income and savings fall behind. In Japan, urban real estate never fully recovered to its 1989 peak in real terms, but financial assets benefited disproportionately from decades of accommodative policy. The gap between asset holders and non-holders widened, even in a society often described as egalitarian. The long-term charts are unforgiving. Compare the price of housing or gold to median income over 20 or 30 years in countries with persistent inflation. The divergence is stark. In many cases, housing prices increase several times faster than wages. Gold, which does not produce income, outperforms cash simply by not being diluted. This is not because gold becomes more productive, but because the currency becomes less scarce. The slow erosion of money reveals itself most clearly when compared to things that cannot be printed. Crucially, this process does not require accelerating inflation. Even stable, predictable inflation can be destructive if it is not offset by real income growth. A steady 4% annual inflation rate has purchasing power in less than 20 years. If wages rise at 2% in real terms or less, the outcome is a quiet impoverishment of anyone who depends on labor and savings. The economy can look healthy by conventional metrics, while households feel increasingly constrained. Central bank credibility often masks this reality. As long as inflation expectations remain anchored, policymakers consider the system stable. But anchored expectations do not mean preserved purchasing power. They mean people have adjusted their behavior to expect loss. When households expect prices to rise, they borrow more, save less in cash, and chase assets. These behaviors are rational responses, but they also entrench the system. Once adaptation occurs, reversing it becomes politically and economically difficult. Another subtle driver of erosion is the mismatch between domestic currency and global pricing. In an interconnected world, energy, food, and industrial inputs are often priced in stronger currencies. When a local currency weakens slowly against global benchmarks, import costs rise even if domestic inflation appears controlled. Over time, this leakage drains purchasing power from consumers. The currency has not collapsed. It has simply lost ground year after year in relative terms. By the time the effects are undeniable, the damage is already locked in. Savings accumulated over decades no longer command a lifestyle they once promised. Retirement assumptions break. Younger generations realize that matching their parents' standard of living requires disproportionate risk or leverage. Yet because the erosion unfolded gradually, there is no clear moment to point to and say, this is when the currency failed. This is a defining feature of currencies that never recover. They do not trigger a reckoning. They trigger adaptation. And adaptation, when repeated across millions of households for decades, transforms a monetary problem into a permanent social condition. At some point, a quiet question begins to surface beneath the adaptation. What if this never reverses? For years, sometimes decades, people tolerate erosion because they believe it is cyclical. Recessions end. Inflation cools. Growth resumes. The assumption is that purchasing power, if not fully restored, will at least stabilize at a higher level of prosperity. But for certain currencies, that moment never arrives. The system does not reset. It settles into a new equilibrium where loss is permanent. Understanding why recovery never comes requires separating two ideas that are often confused: stability and restoration. A currency can stabilize without ever regaining what it lost. Inflation can slow. Volatility can decrease. The exchange rate can flatten. Yet the purchasing power destroyed over 20 years remains gone. Prices do not rewind. Wages rarely catch up in real terms. Stability simply locks in the damage. Japan again offers a revealing case. By the early 2000s, the crisis phase had clearly ended. Banks were recapitalized. Deflation replaced inflation. Interest rates were near zero. On the surface, the worst seemed over. But when economists examined real household income and lifetime earnings, a different picture emerged. According to long-run data from Japan's Ministry of Health, Labor and Welfare, real wages peaked in the mid-1990s and never sustainably recovered. Even as employment stabilized and GDP stopped contracting, the purchasing power of labor remained structurally lower. The yen survived. The economy functioned. But the pre-crisis standard of living, measuring what income could actually buy, never fully returned. Demographics play a critical role in this kind of non-recovery. Aging populations reduce labor force growth and dampen productivity gains. When fewer workers support more retirees, governments face rising fiscal pressure. The politically viable response is almost never higher taxes alone. It is monetary accommodation. Over time, this shifts the burden onto the currency. Japan's rapidly aging population locked the system into low growth and persistent intervention, leaving no room for the kind of productivity surge that might have restored real purchasing power. Debt acts as another constraint. High debt to GDP ratios limit policy choices. Aggressive tightening to restore currency strength risks triggering defaults, financial instability, or recession. As a result, policymakers favor gradualism. Inflation is allowed to run slightly above growth. Interest rates remain suppressed. This combination ensures debt remains serviceable, but also ensures that the currency never meaningfully strengthens in real terms. What looks like prudence is actually a ceiling on recovery. Italy's experience after joining the euro shows how this dynamic can persist even without national monetary control. Once inside a shared currency system, Italy could no longer devalue directly, but structural problems remained. Productivity growth lagged Northern Europe. Public debt stayed high. Without the ability to reset through inflation or devaluation, adjustment occurred through stagnation. Real incomes flatlined. The lira was gone, but the loss of purchasing power continued under a different name. Recovery, in the sense of regaining past standards of living, never materialized. Contrast this with cases where currencies did recover. The United States after the late 1970s is a classic example. Inflation was brutally high, but the response was equally brutal. Interest rates were raised above inflation. Recession was tolerated. Debt was allowed to become painful. The result was a genuine reset. Purchasing power stabilized, and real incomes eventually resumed growth. Germany's post-war monetary reform followed a similar logic. Losses were acknowledged, the old system was abandoned, and a new one was built with credibility restored. What these recovery cases share is a willingness to accept concentrated pain. Defaults, recessions, unemployment, political backlash. These are the costs of restoring a currency's credibility as a store of value. In contrast, currencies that never recover are protected from acute pain precisely because they spread it over time. There is no catharsis. No clean break, just permanent adjustment downward. Another reason recovery fails is that expectations themselves change. Once households and businesses internalize that money will not reliably hold value, their behavior reinforces the outcome. Long-term saving declines. Investment horizons shorten. Asset speculation replaces productive risk-taking. These shifts reduce future growth, making real recovery even less likely. The currency is not just reacting to economic weakness. It is shaping it. Global context matters as well. In a world dominated by a few reserve currencies, peripheral currencies face structural disadvantages. Capital flows toward perceived safety. Even moderate inflation or policy uncertainty can trigger long-term outflows that never fully reverse. A currency does not need to collapse to be sidelined. It only needs to lose its role as a preferred store of value internationally. Once that happens, regaining trust is extraordinarily difficult. By the time a society realizes that recovery is not coming, the question changes. It is no longer how we fix a currency, but how do we live with it? Policies focus on mitigation rather than restoration. Subsidies replace growth. Asset ownership replaces income security. The economy becomes less dynamic, but more stable in a narrow sense. The currency continues to function, but only within these lowered expectations. This is the point of no return for currencies that never recover. Not because collapse is inevitable, but because the political and economic conditions required for a true restoration no longer exist. The system has found a way to survive without fixing the underlying loss, and survival, over time, becomes the enemy of recovery. The final stage does not arrive with an announcement. There is no decree that declares a currency finished, no official acknowledgement that something fundamental has been lost. Life continues. People work, trade, save, invest, and retire using the same units they always have. And yet, beneath the surface, the role of money in society has permanently changed. This is the ending that never really ends. By this point, trust in the currency as a store of value is gone, even if few people articulate it that way. Households no longer ask whether money will hold its value. They assume it will not. Saving becomes a tactical decision rather than a moral one. Cash is something to be moved, not kept. Long-term financial security shifts away from income and toward ownership of assets that sit outside the currency's reach. Real estate, foreign currencies, equities, commodities, anything that cannot be diluted as easily becomes a substitute for money itself. This adaptation reshapes everyday behavior. People borrow more aggressively because debt is perceived as safer than savings. Mortgages stretch across decades. Leverage becomes normal. The future is discounted, not because people are reckless, but because the currency teaches them that waiting is punished. In countries like Argentina, this behavior is explicit. Salaries are spent immediately, contracts are indexed, and foreign currency is hoarded whenever possible. In countries with slower erosion, the same behavior exists, only disguised behind financial products and asset markets. Over time, the social consequences become entrenched. Wealth stops being built primarily through work. It is inherited, leveraged, or acquired early through asset exposure. Those who enter the system late face a permanently higher barrier. Housing affordability collapses relative to income. Retirement becomes uncertain unless assets were accumulated decades earlier. These outcomes are often blamed on inequality, globalization, or technology, but the currency's long erosion is the quiet foundation beneath them. The government adapts as well. Policy shifts from growth to management. Stimulus replaces reform. Monetary tools are used not to restore purchasing power, but to prevent visible failure. Inflation is tolerated as long as it does not spark unrest. Asset prices are defended because they underpin the balance sheets of households and banks. The system becomes increasingly fragile, yet paradoxically more stable in appearance. Crises are postponed, not resolved. What makes this stage so difficult to escape is that no single group feels fully responsible. Each policy choice is defensible in isolation. Each year's inflation is explained by unique factors. Each intervention is described as temporary, but together, They form a permanent architecture of decline. The currency is no longer a neutral measuring stick. It is a policy tool adjusted constantly to balance competing pressures. At this point, comparing the currency to its past becomes almost meaningless. A unit of money from 20 or 30 years ago cannot be translated cleanly into today's reality. The lifestyles, expectations, and economic structures are too different. People stop remembering what the currency once promised and focus instead on how to navigate what it has become. The loss fades into history, even though its effects remain embedded everywhere. Importantly, this is not a story of chaos. Streets are not burning. Shops are not empty. The currency still works. That is why the ending is so easy to miss. The failure is functional, not catastrophic. Money still moves, but it no longer anchors the future. It has been demoted from foundation to utility. This is why currencies that never recover are more dangerous than those that collapse outright. Collapse forces reckoning. It compresses pain into a moment that cannot be ignored. Slow death disperses pain across generations. No one generation feels robbed enough to revolt. Yet each inherits a system with less room to breathe than the last. And so the process concludes without conclusion. The currency continues to exist, stripped of its original purpose, but kept alive by habit, law, and necessity. People adapt, institutions adjust, and the economy carries on at a lower altitude. The end is not an event. It is a condition. If a currency does not die in a night, but over 20 years, then the most important question is never will it collapse. The real question is always quieter. How far into the process are we already?